You've got clients with various amounts of cash investments in their portfolios. The most popular are CDs, high yield savings, and money markets. But the Fed cutting interest rates means the rates on all those accounts will drop too. And that's not all. The rates on annuities are going down as well. So talk to us, Sean, about if there is time to lock in rates that are still favorable.
Yeah, it's that time for sure. Those who have been relying on interest rates for the last few years definitely want to be proactive at this point, make decisions on the fixed income strategies moving forward. We've had high interest rate environment for, last 3 years. Jerome Powell, the Fed chair, was a little late to the inflation party, thinking it was transitory. Maybe he should have raised rates much earlier. Most analysts were waving the flag in late 2021. A lot of analysts right now believe he should have been lowering interest rates this year already. There are many good reasons for that, but I think Powell has had kind of a legitimate argument that there has been some uncertainty in how tariffs would affect inflation. That ship has probably sailed. He did cut by a quarter point last month. The market is projecting another 2 cuts this year. Of course, Powell's hawkish history would suggest they'll probably be slim, maybe another quarter point each. But his term ends in May of next year, and that's a big deal. If the new chair leans more dovish, leans towards lowering interest rates, we could see significant reductions next year, having a real effect on fixed income yields. It's important to keep in mind that the markets try to predict the future by 6 months. So there's probability that those products that guarantee interest rates for a period of time in the future, like CDs, bonds, annuities, their rates could start to come down before and even outpace the Fed's reductions. So to answer your question, though, Casey, yeah, we're still in a high interest rate environment with opportunity to lock in unusually high returns, but we are already seeing a downward trend. So I really encourage individuals that want to continue to use fixed income strategies and benefit from those high rates into the future. Start making decisions now. We'll probably continue to see the opportunity diminish.
You know, it feels just like when we get comfortable with our saving strategies, the landscape shifts again. So with the Fed now signaling that rate cuts are on the horizon, a lot of folks are probably wondering what that means for the cash that they've set aside. So, Sean, how should investors be thinking about reallocating those cash holdings to make sure that they're still getting the best yield possible?
Yeah, it's a really good question. And we have to at least assume we won't see this opportunity for years to come. So it really deserves strategic planning. But with all investment strategy, we have to be clear in what we're trying to accomplish. Time horizon of each dollar is key in fixed income planning. So start by determining how many dollars you want available each month from that fixed income part of the portfolio, and then identify those products with guarantees, especially offered by companies with financial strength ratings based on your comfort level and the rates that they offer. And I'll suggest that currently annuity companies are offering significantly higher rates than alternatives. Laddering strategies might be beneficial depending on the situation. And I want to remind people to consider guaranteed lifetime income options as well. Annuity companies are offering some of the best deals we've seen in decades because of the temporary interest rate environment we're in right now. We've been designing an income plan for Alan and Jody, who a couple weeks ago came into our office for our financial planning assessment. And they decided that having a comprehensive retirement plan would be in their best interest. And they wanted a guarantee a portion of their income needs in retirement, which is starting in 2 years. So we used a combination of annuities and treasury bonds. Those rates are guaranteed, but those will mature periodically throughout the next 8 years, along with Jody's Social Security. And then we also positioned an annuity that will guarantee an income for life. It's starting in 8 years, along with Alan's Social Security. This kind of a guaranteed income strategy will pay their projected living expenses, but allows the rest of their portfolio to take advantage of the long-term market gains that can be used for inflation, long-term medical expenses, and eventually legacy to the kids. This is an income strategy that requires comprehensive planning because of the time horizon and liquidity nature, along with tax implications. And it all started with the initial consultation. So I want to extend an invitation to our listeners. Give our team a call, 559-847-0039. And if you're one of our first 5 callers, we're going to waive our consultation fee, and we're going to provide you with your own individual financial planning assessment, your portfolio analysis, estate plan, the income strategies we've been discussing, all the elements you have to be addressing for retirement. Again, that number is 559-847-0039. Give us a call and our team will schedule a good time for you to come in.
And I just want to emphasize, there is no obligation here. There are no strings attached. This is just a conversation. You want to get on Sean's calendar while he's got these spots available. He's local. He's eager to see how he can help you. So give us a call, 559-847-0039. That number again, 559-847-0039. Or you can always head to MasonStreetRetirementInsights.com and you can get started with us online as well. All right, I want you to think about how much will you spend in retirement. The rule of thumb is that retirees will spend around 70 to 80% of their working year's income, but a new study by JP Morgan went further and found that 60% of households will see their spending go up and down in the early years of retirement. It's something that financial planner Kevin Lum calls spending volatility. Take a listen.
Retirement spending is going to be bumpy. Some years you'll spend 20% more. Some years you'll spend 20% less. It's not a big problem as long as the averages work out and you manage the risk. But it does increase risk because often when you first retire, spending can be a bit hard to predict because you're new to retiring. And so you might think you're going to spend $100,000 a year. If you plan for $100,000 a year and then you spend $120,000 or $150,000, it can mess up your income plan.
So have you noticed this with some of your clients, Sean? How do you plan for spending volatility in those early years of someone's retirement?
Yeah, for sure. I've noticed it. I notice it quite a bit. But Casey, it's one of the most consequential elements that affect a family's lifestyle and quality of life in retirement. Income is what drives that lifestyle, and the amount a family will need depends on their lifestyle that they want in retirement. If you want to live your greatest life in retirement, you have to, at least on some level, be intentional about what your greatest life looks like. Then we can start to narrow down how much a family will need to spend. And Casey, you mentioned the rule of thumb that we'll spend 20% less in retirement. But if you separate out the mortgage expense and the expense of raising of kids, I'll suggest that most people will spend more in retirement. They'll have an additional 40 hours per week. And most of the families that I work for want to spend that time on their dreams, travel, grandkids, hobbies. All of this requires money. I do agree there's a period of time new retirees go through to get used to their new life and how much it costs and the mechanics of turning savings into income. I counsel families to expect the first 6 months to be a learning curve and that's okay because we'll adjust along the way. But with that said, I've found over the 20 plus years, having that comprehensive retirement plan reduces spending volatility. And by going through our financial planning process, people do become more intentional about what they want. I was meeting with the Litchfields last week for a quarterly review, and we were talking about when we first started working together, and this was 6 years ago, we created their income plan that would pay for the lifestyle they expected. But we also earmarked another bucket of money that they could feel confident in using if they decided along the way to do more than originally expected. And they did end up spending more on several trips through the years because they took their kids who also got married. So the traveling crew got better. They said they were so happy that they were able to have that extra without any worry. But they still have enough in that bucket left over. And now they're thinking about buying a boat. So we're building scenarios in their plan to figure out the most efficient way to do that. Look, life can be a lot of fun. We just have to figure out how to allow it to be.
Yeah, it's always fascinating to watch how retirement brings not just financial changes, but real shifts in how people approach their lives. So, with that in mind, Sean, what are some of the biggest behavioral shifts that you notice in retirees when that income stream changes from earning a salary at their job to now withdrawing from their savings?
It's an interesting dynamic, how people handle the realization that they don't have the paycheck anymore. And I recognize, and I'm generally speaking, but I recognize a stark difference between the families we started working with before they retired and the families we met after they retired. There's often a sort of uncertainty, concern, a feeling of not knowing in people when they retire without a comprehensive retirement plan, and understandably so. And the result is usually a fear of spending. It's one of the greatest injustices that I see. They work all of those years. They deserve a certain quality of life, and instead they live less than. If you know my story, you know why I'm so passionate about what I do, and it is this. I watched my mom suffer with the same feeling, and I had to fix it. When families go through a financial planning assessment, we use a specific methodology called RISA, Retirement Income Style Awareness. And it really helps me, but more importantly, helps the family I'm working with to identify the income strategy that will give them the most spendable income, but at the same time, give them that peace of mind that their lifestyle will be as they expected without worry. And for most of us, that's the goal, a stress-free retirement with the lifestyle we expect.
It's one of the biggest mental hurdles in retirement, that fear of running out of money. It can be so powerful, and it can really keep you from enjoying the retirement that you worked your whole life to build, which is exactly what we do not want to happen. And that's where Sean comes in. So if you've ever wondered, can I really afford to do this in retirement? Now's the perfect time for you to get the answers that you've been looking for. So give us a call. 559-847-0039 is that number to dial. Sean's got those 5 spots on his calendar set aside for our radio listeners. So take advantage of this opportunity while you can. Again, that phone number, 559-847-0039, or you can always visit us online. We are at MasonStreetRetirementInsights.com. You are listening to Mason Street Retirement Insights. I'm here with financial advisor and president of Mason Street Wealth Management, Sean Mason. And we are chatting about the biggest retirement topics today. And Sean, 401ks have been looking good lately, thanks to many investing in the so-called Magnificent Seven group of tech stocks. But can this be too much of a good thing? Here is wealth manager Ryan Payne on Fox Business recently. Take a listen.
I think it's a very healthy bull market. We are starting to see this bull market spread out. And I think if you think about growth is accelerating. In fact, this quarter, we're looking at 3.9% GDP growth, which is like off the charts. That's more than historical average. So anything that's like cyclical or is tethered to the economy are a great place to be. And there's so many places that trade cheap versus the Magnificent Seven. And I see this with everyone's portfolios. People are just over levered to that Magnificent Seven trade. And there's lots of great places to put your money right now.
So, Sean, can you think of some less risky options? What are you telling clients who are just a few years away from retirement right now?
Yeah, it's really been an anomaly, the Mag 7. But I haven't been too concerned about the risk profile of those companies. They're large cap domestic companies who have proven over the years to adapt to the environment they find themselves in. But at this point, their valuations are extremely high compared to earnings. And from a fundamental perspective, we wouldn't suggest any exposure to them. But as we all know, we're in an extraordinary period of advancement in technology innovation. So there might be an argument on some level to kind of think outside the fundamental box. I still think technology and asset classes directly correlated will lead the pack, but diversification should always be foundational, especially in a family's investment portfolio. Current trends are showing a broadening of the market, meaning growth in more sectors across the markets. That's an indicator that a diversified portfolio should do well. But many analysts are projecting a slowdown in the economy due to tariffs and low immigration policy. To me, that seems to be more of an opinion on the policy agenda of the current administration, and so far it's been difficult to bet against them. It's also worth remembering how historically a high interest rate environment has created a negative consequence in the financial markets. We have to keep an eye on that for sure. There are many reasons to plan on continued uncertainty, and trying to time the market rarely works out for people. We as a firm rely on fundamentals, staying diversified, and using investment strategies that limit exposure to losses while allowing reasonable growth.
Sean, I'm sure we've got some listeners approaching retirement and wondering if it's time for them to play things a little safer. So if someone's, let's say, 3 to 5 years from retirement, they've ridden the tech wave up, what would you say is the first smart move to start dialing back that risk? Would it be about reallocating their investments or simply maybe trimming some of the tech exposure? What do you think here?
Well, that's actually when most people come to us, when they're 3 to 5 years from or in retirement. We've had an incredible run in the market for over a decade. And yes, there's been some bumps, but the S&P 500 is up over 300%. And the Mag 7 is up an astounding 2,500%. But Casey, to answer your question, I'd suggest a shift in perspective. When we're working, the priority is growth. We contribute as much as possible to the retirement account and we grow it. But when we reach the transition phase, 5 years from retirement, it's essential to recognize that priorities change. Now investments have to support strategies in the retirement plan. There are hosts of investment instruments, structured notes, indexing strategies, high dividend funds that we have at our disposal. Risk tolerance, both emotional and pragmatic, and time horizon for every dollar we have becomes a priority in retirement. The income plan, the tax plan, the investment plan, they all have to work together in harmony. One piece of the puzzle is always affecting other pieces of the puzzle, so we have to take a holistic approach. And this is why comprehensive planning is so important. So I want to encourage our listeners to give our team a call at 559-847-0039. And you want to call right now because for our first 5 callers, we're going to provide you with your own individual retirement planning assessment, an analysis of your investment portfolio, your estate plan, tax strategies, all those elements you have to be considering in retirement. And we're going to do all this with no charge because it's that important. So give our team a call at 559-847-0039, and they'll help you schedule your comprehensive retirement planning assessment.
And I just want to make sure our listeners know Sean will do this introductory assessment for you completely complimentary. You can meet with him. He will take a look at your big financial picture. You can talk through your goals and you can work on that best path forward together. So get on his calendar while you can. Let's see how he can best help you. That phone number again, 559-847-0039. That is 559-847-0039, or you can always head to MasonStreetRetirementInsights.com and you can get connected online. All right, I know you're a big sports guy, Sean, so I like to throw in some sports talk whenever I can. Today we're going to talk a little golf. If you're playing golf with your buddies and your ball lands a foot or so from the pin, oftentimes they'll give you a gimme putt and you can pick up without truly completing the hole. But an article I saw this week in the Wall Street Journal insists that this is undermining the game. And it made a point that even pro golfers miss short putts sometimes. So thinking about this in retirement planning terms, Sean, many might assume that Social Security, maybe a pension, is enough income. But how do your clients react when you sit down with them and you develop a much larger income plan for their retirement?
Well, Casey, gimmies are easy to give, except when the loser has to buy the first round of drinks. And we're all ordering top shelf.
Great
the problem
point.
for me is, right? The problem for me is too often I'm the one buying the round. But this is a good topic to address. Fewer people have a pension these days. Most companies don't want the liability in offering a pension plan. So they've gone to that 401k model, which puts the risk back on the employee versus the employer. But you're right. That pension can give people a sense of security, which is good, but they still have to be aware of the elements that can have a negative effect on their quality of life. Inflation is the biggest mistake families with pensions make. Very few pensions, and all that Social Security as well, what we hope are guaranteed incomes rarely keep up with inflation. Even cost of living adjustments or COLA usually falls short. This will result in either having a lower lifestyle or risking running out of savings earlier than expected. It can also affect long-term healthcare funding and legacy to the kids. So comprehensive planning is key. Often those with pensions and Social Security are best served by saving a portion of their income in early years so they can use it in later years to pay for the extras. But families who have savings they'll use to supplement those incomes, they're going to need distribution and tax planning. They've got to be careful that withdrawals from savings can become an unexpected tax nightmare, creating more tax on the Social Security and pushing them into higher tax brackets. And then families with pension income that have accumulated assets, they're going to want to ensure they're implementing advanced legacy strategies. Most of us don't want the government to be our beneficiary. And then having a clear understanding how RMDs, or those required minimum distributions, can cause extreme taxation is also essential. The solutions you use to mitigate these concerns, they're going to be based on certain criteria: risk tolerance, rate of return needs, your tax situation. An annuity can be positioned to guarantee the supplemental income needed, while dividends have the probability of producing higher income, but they're not guaranteed and can fluctuate. Tax mitigation strategy has to be included in planning for pension and Social Security income. The great benefits of these income sources can cause significant unnecessary taxation.
That is going to do it for us this week here on Mason Street Retirement Insights. As always, thank you so much for joining us, and we will be back next week, same time, same place, with more great insight from Sean Mason, president of Mason Street Wealth Management. Take care.
Mason Street Wealth Management, MSWM, is a registered investment advisor, and the opinions expressed by MSWM on this show are their own and do not reflect the opinions of Motivate Investments. Registration is not an endorsement by securities regulators. Investment advisory services are offered through Motivate Investments, an SEC-registered investment advisory firm. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. By contacting us, you may be provided with information about insurance products, including annuities, offered through Sean A. Mason, California, insurance license number 0B54860. The firms are separate entities. Annuity guarantees rely on the financial strength and claims-paying ability of the issuing insurance company and are not offered by Motivate Investments. Read your contract for restrictions, limitations, or penalties. MSWM is not licensed in all 50 states. To find out if MSWM is licensed in your state, please call 559-892-0002.